Hi, I'm Mark Power, Head of Income Credit Strategies at Qualitas. And today I'll be talking to you about one of our funds, being the Qualitas Real Estate Income Fund, otherwise known as QRI. But before we do a deep dive into QRI, I'll firstly tell you a little about Qualitas itself and also about the opportunities that we see in the private credit real estate market. So Qualitas as a business was started back in 2008. It's one of Australia's largest private real estate investment managers, investing discretionary funds across both private credit and private equity. We were a listed firm, listed in December 2021. We've grown significantly since inception and currently have $7.5 billion of funds under management. We have 80 professionals across the team in Sydney, Melbourne and Brisbane offices. Interestingly, the majority of the capital that we raise into the business is from institutional investors. So when I say institutional investors, largely offshore sovereign wealth funds, pension funds, insurance companies and the like. I think a really good place to start when we're talking about private real estate credit is the actual size of the addressable market. And in one word, it's enormous. And it continues to grow at a very healthy pace. In fact, over the course of the past 10 years, it's grown at a compound rate of growth of 6% per annum. Interestingly, the major banks who once dominated this sector have been growing over the same time period at 3% per annum. So effectively what's happened is over the course of the past decade, the major banks have acceded significant market share, reducing from, as I was saying earlier, a once dominant 86% of market through to about 73% of the market today. And we don't see that trend changing anytime soon. In fact, if anything, it's accelerating. And that reduction in market share from the major financiers hasn't been an accident. It's actually been an orchestrated strategy by the regulator here in Australia, being APRA. And the regulator post-GFC wanted to ensure that the financial system could absorb further shocks, such as a GFC Mark II. And one of the levers they pulled on to ensure that occurs was essentially a de-risking of the bank's balance sheets and their exposures into commercial real estate. So what that's effectively meant is that the sandbox that those traditional financiers operate in has narrowed significantly and created a real capital gap in the marketplace for private lenders such as Qualitas to lend into. So other than the very strong opportunities evident in the broader real estate market for private lenders to lend into, one of the questions we often get asked is why Australia and why we're seeing those very strong capital inflows come on through. And there are a number of statistics up on the slide that you can see there. The one that I want to point out though is population growth. So Australian real estate is very much underpinned by very, very strong population growth in this country. So for the period out to 2030, we're projecting population growth of 12%. In fact, over the course of the past year, population growth has been running at 2.2%, which is the highest level of population growth since 1961. I think it's important to describe to people where commercial real estate lending actually sits on the risk-return spectrum. And it's important to delineate between investing in the equity part of the stack as compared to the debt part of the stack. So when we're talking private lending, we're investing in the debt part of the stack. So what that means is that you've always got first claim on cash flows coming out of the asset, and in a realisation position, you've always got first claim on cash flows from any refinance or any sale of the asset. So you'll see there on screen, in terms of where that sort of investment sits on the risk-return spectrum, it's somewhere between investment-grade corporate debt and high-yield corporate debt. In terms of the sort of loans that we make within our strategies, they can be placed into a number of buckets. Firstly, and I'll start with those at the lower end of the risk spectrum and then move up from there. So firstly, you're looking at investment loans, which are loans against income producing commercial real estate or assets going through some form of repositioning. There's also residual stock loans, which are loans against lines of recently completed but unsold residential apartments. We have pre-development land loans, so these are primarily inner city sites which are very close to actually being activated into a live construction project. And then we have construction loans themselves. We're actually funding the development of it could be a high density, medium density residential development, office building, shopping centre and the like. So let's talk now about the Qualitas Real Estate Income Fund, or QRI, as I mentioned earlier. The key pillars of this fund are around providing regular monthly distributions to investors with the potential for capital preservation. It's a fund which is listed on the ASX. Its initial IPO was back in November 2018. It's currently a fund of $601 million, and the target return to investors is 5 to 6.5% above the RBA cash rate. We're well covered by the research houses, with Zenith providing a recommended rating on QRI and Lonsec providing an investment grade rating. Also very well supported with the product on a number of platforms, as you can see there on screen. The key features of QRI, I mentioned earlier around monthly distributions. It's a very important aspect of the fund for our investors. And we've provided those monthly distributions all the way since inception back in 2018. If we look at how the fund's performing at the moment, and we annualise the monthly return for August just gone, currently providing an annualised distribution of 8.8% per annum. The other key feature of the fund is you are investing in the debt part of the capital stack, and capital preservation to our investors is absolutely paramount. So since the fund actually launched, we've maintained the NAV of QRI at or above $1.60 since inception. Another interesting point we often get asked is where QRI should actually be placed within any investment portfolio. And the answer is there's no simple answer effectively. It can be really placed in one of three different buckets. It could be considered fixed income, simply because of the fact that you're actually, the investor's receiving that monthly distribution each and every month. Could be viewed as property because of the fact that whilst you're not investing in the equity part of the property, you are, the underlying security on the loans that you're making are actually property in nature. And then thirdly, it could also be considered an alternate because of the fact that it's essentially private credit. One of the key changes with QRI that's occurred over the course of the past month is that we've recently been incorporated into the ASX 300 and ASX 300 A-REIT indices. What that means for QRI is that essentially increases the liquidity in the stock, and we've seen that happen over the course of the past few months, as it was becoming more and more likely that we were going to be included in those indices. And it also expands our investor universe significantly. As far as QRI goes, it's a fairly simple product. It's currently 36 loans that sit within the portfolio, providing a good level of diversification. It's predominantly first mortgage. It points very heavily into the residential sector. So 77% of the fund is actually investing in the residential property market. So we've actually got really strong conviction in this part of the market. And the reason we do, I mean, I've been in commercial real estate debt now for about 33, 34 years. And I can't recall a time where there's been such an enormous disconnect between supply and demand in any sub-market. And if we start to break that down in residential here in this country, we're sitting at the moment in a situation where we've got chronic undersupply. And that's evidenced by the fact that the residential vacancy rate at the moment is in the low ones, essentially across the eastern seaboard. If you compare that to a market in equilibrium, you want that vacancy rate to be running at around about 3%. So already in chronic undersupply. Then we've got this wall of demand coming through from very, very strong population growth that I spoke to earlier, which is expected to continue over the foreseeable future. In fact, the most recent federal budget papers on the forward estimates were forecasting net overseas migration in the periods 2027 of 1.5 million people. And that's just from net overseas migration, excluding the natural rate of population growth. So you've got chronic undersupply, you've got a wall of demand coming through, And then if you look at the supply forecast of dwellings over the next few years, you're actually looking at a market which is going to be delivering product at decade lows. So you've got this massive disconnect. So for us, if we're investing into that market, we think it's supported by really strong fundamentals and is very defensive in its nature. The other important part of where we invest within QRI is geographically. We're very New South Wales and Victorian centric, which accounts for around about 80% of the portfolio. And when I say New South Wales and Victoria, that's essentially Melbourne and Sydney. They're the two gateway cities in this country. They've got the largest, deepest real estate markets, and that's essentially where we're looking to place the majority of our capital within QRI. So why is now a great time to invest in QRI? Firstly, the returns are strong. So you're looking at monthly returns, as I mentioned earlier, on an annualised basis for August, currently running at 8.8%. And that's supported by the elevated level of interest rates that we're currently experiencing in this country. The thing about investing in debt is that as interest rates rise, the borrowers of those underlying loans are paying a higher interest rate, which flows straight through to investor returns. So if you believe in the view at the moment that we're higher for longer in terms of interest rates, you'd expect the returns within QRI to continue to remain at very strong levels. You're also investing in a fairly defensive asset class, which isn't necessarily correlated to the rest of the equity market. So in times of uncertainty, like we have here at the moment, it once again provides the ability for protection of capital over the long term, whilst also enjoying those high returns. And I think in summary, what I'd say about QRI is in inflationary times like we're experiencing at the moment, it actually provides a really good inflationary hedge. Now, if you think about inflation and how that manifests through the broader economy, in order to stem inflation, the Reserve Bank will increase interest rates as they've been doing so. As interest rates increase, that actually benefits the investor in QRI because of the fact that that additional interest rate that the borrower has to pay is flowing straight through to the investor. Thank you.